In today's video, I'm pulling back the curtain on how wealthy retirees legally pay zero in taxes after age 60, while most retirees unnecessarily hand over 20 or 30% plus of everything they've ever saved. The difference is so dramatic, it honestly feels a bit unfair. And that's exactly why I'm making this video. 5 strategies, fully legal. Let's get into it. If you're new here, I'm Eric Rodriguez. I'm a certified financial planner, and for the past 20 years, I've helped hundreds of retirees keep more of their hard-earned money out of the IRS's hands. Our team manages tens of millions of dollars, specifically in retirement assets, and what I can tell you with complete confidence is this. The number one mistake we see retirees make has nothing to do with their investments. It's their tax strategy, or more accurately, the fact they don't have one. And by the time most people realize that, it's already cost them tens of thousands, if not millions of dollars that they're never going to get back. Here's the reality most retirees face. You spent 30 years doing everything right. You've maxed out your 401k retirement plans. You've saved diligently. You've made sacrifices, but what nobody told you, what your HR department certainly didn't mention, is that the IRS has been your silent partner this entire time. Every dollar you pull out of your pre-tax retirement accounts gets taxed as ordinary income. Your Social Security gets taxed, and when you hit 73, your required minimum distributions force you to take money out, whether you need it or not, pushing you into a higher and higher tax bracket, whether you like it or not. You see, the wealthy figured something out a long time ago that most retirees never learn. It's not about how much you make. It's not even about how much you save. It's how much you keep. And keeping more means having a tax strategy and not just an investment strategy. These 5 hacks I'm going to share are exactly how the rich do it. And starting today, they're going to be yours too. Let's get into it. Here are the 5 tax hacks wealthy retirees use to legally pay zero in taxes after the age of 60. Here's hack number 1, the new standard senior deduction. This first hack has a specific number attached to it that I want you to write down. Actually, don't write it down. Screenshot this because this number is going to change the way you think about retirement income forever. Most people know what a standard deduction is. It's the amount of income you can earn completely tax-free before the IRS takes a single dollar. The higher that number, the more money stays in your pocket. For years, the standard deduction has been a useful but unremarkable part of the tax code. That just changed in a very big way. When the one big beautiful bill was signed into law on July 4th, 2025, most people focused on the headlines. What they missed, buried deep inside the legislation, was one of the most powerful tax gifts ever handed to American retirees. Not only did the one big beautiful bill make the existing standard deduction permanent, it added a brand new $6,000 bonus deduction exclusively for Americans 65 and older. $6,000 per person on top of everything else. So here's what that looks like in real numbers. If you're single and over 65 in 2026, your total standard deduction is $24,050. If you're married and both of you are over 65, you're looking at $36,100 of retirement income you can receive completely tax-free, zero income tax from a federal level, that is, nothing, before you've done a single thing. Now, here's the move the wealthy make the most retirees miss entirely. They structure their retirement income to stay at or below the threshold. They coordinate their Social Security timing, their IRA withdrawals, their Roth conversions, all engineered around that number. And the result is a tax bill that looks shockingly close to zero. One important note, the $6,000 senior bonus deduction does phase out above $75,000 for single filers and $150,000 for joint filers, which actually means this hack is specifically designed for middle-class retirees. The wealthy know about it. Your accountant may not have mentioned it yet. Well, now you know. But here's the truth. The standard deduction alone won't get you all the way to zero. You need to stack it with the other hacks I'm about to show you, starting with one of the most powerful and most ignored accounts in all of retirement planning. Here's hack number 2, the HSA, the retirement account nobody talks about. If someone told you there was a retirement account that gave you a tax deduction when you put money in, grew completely tax deferred, and let you take money out tax free, you think they were making it up. That account exists. It's called a health savings account. And the wealthy have been maxing it out every single year, while most retirees don't even have one. And here's how it works. An HSA is available to anyone enrolled in a high deductible health plan. You contribute pre-tax dollars, meaning you get an immediate tax deduction. That money grows tax-free inside the account. And when you withdraw it for qualified medical expenses, you pay zero taxes. Not reduced taxes, zero taxes. Now, here's where it gets really powerful for retirees. Healthcare is the single largest expense most people face in retirement. We're talking about an average couple spending somewhere between $300,000 and $350,000 on healthcare costs after the age of 65. That's a staggering number. And an HSA lets you pay for every single one of those expenses with completely tax-free dollars. But the wealthy take it one step further. They don't just use their HSA as a healthcare piggy bank. They treat it as a stealth retirement account. They max their contributions every year. In 2025, that was $4,300 for individuals, and it was $8,550 for families. And they invest it aggressively in things like low-cost index funds. They pay their current medical expenses out of pocket, saving every single receipt. And then 10 years later in retirement, they reimburse themselves for those expenses tax-free, essentially creating a tax-free income stream they engineered years in advance. The move is simple. If you have access to an HSA, max it every single year. Invest it, don't touch it, let it compound. Your future self will thank you in a very significant way. All right, here's hack number 3, the 0% capital gains bracket and tax gain harvesting. This is the hack that makes most people do a double take the first time they hear it, because the move I'm about to describe sounds almost too good to be true. It's not. It's just the tax code working exactly the way it was designed to, and the wealthy have known about it for years. Here's the setup. When you retire, especially in those early years, before Social Security kicks in fully and before those RMDs begin, you may find yourself in a surprisingly low income year, lower income than you've had in decades. And that low income year is not a problem. It's an opportunity. And here's why. The federal capital gains tax has 3 rates: 0%, 15%, and 20%, depending on your income. So for example, for 2025, if you were married filing jointly and your taxable income was below $96,700, your long-term capital gains rate would have been exactly 0%, meaning you could sell appreciated assets and owe the federal government absolutely nothing on those gains. Now, here is the move the wealthy make that most retirees never consider. It's called tax gain harvesting, and it works like this. You intentionally sell your appreciated investments, your stocks, your ETFs, your mutual funds, whatever has grown during that low income year. You realize the gains at 0%, and then you immediately repurchase those same investments at the new higher price. What you've just done is reset your cost basis completely tax-free, which means your future tax liability on those investments has just been dramatically reduced or eliminated entirely. Think about what that means for a second. You're not avoiding taxes forever. You're legally eliminating them on gains that have already been earned. The IRS allows it. It's completely legal, and it's one of the most powerful moves available to retirees in that early retirement window. The wealthy execute this strategy every single year without fail. Most retirees have never heard of it. And here's the beautiful part. Those same low income years that make tax gain harvesting so powerful, they're also the perfect window for hack number 4, which is Roth conversions in those low income years. If there's one strategy, I know you've heard this a million times on YouTube, but if there is one strategy on this entire list that has the single biggest long-term impact on your retirement tax bill, this is it. Roth conversions in your low income years. And once you understand how it works, you're going to wonder why you didn't start doing this sooner. Here's the core idea. Your traditional pre-tax 401k and IRA are loaded with what I call these pre-tax time bombs. Every dollar in those accounts has never been taxed. And the IRS is very patiently waiting for you to pull that money out so they can collect. When you do, every dollar comes out as ordinary income. And when you hit that 73-year-old mark, your required minimum distributions force you to take money out whether you want to or not, often pushing you into tax brackets that genuinely hurt. So the rich and the wealthy, they don't wait for that to happen. They identify the window typically between the day they retire and the day their RMDs begin. And they use that window to systematically convert their traditional IRA and 401k money into a Roth account. They pay taxes on those conversions now at today's lower rates, and in exchange, they get tax-free growth and tax-free withdrawals for the rest of their lives. No RMDs, no forced distributions, no surprise tax bills. And here's the key insight I want you to take away from this. You're not avoiding taxes with a Roth conversion. You're choosing when you pay them and how much. It's the realest hack out there. The wealthy don't leave that decision to the IRS. They make it themselves on their terms at the lowest possible rate. The move is to work backwards from your RMD start date and map out a multi-year conversion strategy that fills up your lower tax bracket every single year. Stack it on top of your standard deduction from hack number 1, and you can convert significant amounts of money at extraordinarily low or even zero tax rates. All right, let's move on to number 5, the tax optimized brokerage account. The final hack is where everything comes together, and it's the one that separates truly sophisticated retirement tax planning from everything else. Most retirees think about their brokerage account in terms of returns. What did it earn this year? What's my balance? Well, rich and wealthy retirees think about their brokerage accounts much differently. They think about after-tax returns, because a 10% return that gets taxed at 37% is worth significantly less than an 8% return structured to be taxed at 0%. Here's what a tax optimized brokerage account looks like in practice. First, qualified dividends. Not all dividends are created equal. Qualified dividends are taxed at the lower capital gains rate, not as ordinary income. So wealthy investors, what they do is they structure their portfolios specifically to generate qualified dividend income rather than ordinary income. The difference in tax treatment can be enormous over time. Now, the second thing is the tax loss harvesting piece. This is the practice of selling investments that are currently at a loss to offset gains elsewhere in your portfolio. Done consistently and strategically, it can dramatically reduce your annual tax bill while keeping your overall investment strategy completely intact. Now, the third thing here is asset location. This is the art of placing the right investments in the right accounts. Tax inefficient assets like bonds or REITs go inside your IRA and 401k where the tax drag is sheltered. Tax efficient assets like index funds and stocks go in your taxable brokerage where they can generate qualified gains and dividends. It sounds simple, the impact is significant. Wealthy investors obsess over after-tax returns. They have advisors running these numbers constantly. Most retirees only look at pre-tax performance. That gap between pre-tax thinking and after-tax thinking is where thousands of dollars are lost every single year. Let's bring it home. 5 hacks, all legal, all used by wealthy retirees every single day. Hack number 1 is knowing your new standard deduction numbers under the one big beautiful bill and structure your retirement income around them. So remember, a married couple over 65, they can shelter up to $36,100 completely tax-free. Hack number 2, max out your HSA every single year, invest it aggressively, and use it as a tax-free healthcare and retirement account. Hack number 3, identify your low-income years in early retirement and harvest your capital gains at that 0%. Reset your cost basis for free. Hack number 4, execute those Roth conversions during those low-income years before your RMDs kick in and take the decision out of your hands. And hack number 5, build a tax-optimized brokerage account that generates qualified dividends, harvests losses strategically, and locates assets for maximum after-tax efficiency. You do all 5, and you're playing the exact exact same game the wealthy have been playing for years. The rules were always available to you, and now you got the playbook. Here's the truth. None of these strategies are very complicated, but they do require a plan. A real plan built around your specific numbers, your specific timeline, and your specific situation, because the window to execute most of these hacks is not unlimited. Every year you wait is a year of tax-free growth you don't get back. If this resonated with you, if you want to sit down with our team and map out exactly which of these strategies applies to your situation, I've made it incredibly easy to get started. Click the link in my bio to book a free intro call. We'll look at your numbers, identify your opportunities, and show you exactly where the IRS has been winning at your expense. It's time to change that because you didn't spend the last 20, 30 plus years building wealth just to hand it over unnecessarily. Let's make sure you don't. Thanks so much for watching, and I'll see you in the next video.